Let's play a little game. How much money would you need invested so you never have to work again? Let's say you'd love to live purely off dividend income. Our first question, how much per year do you need to feel comfortable? About $3,300 to $3,500 a month? That's roughly $42,000 a year. Now, for some of you, that number might be higher. For others, lower. But $40,000 is a solid middle ground to work with. So today, we're breaking down the math, the myths, and the method for living off dividends, and why dividends shouldn't be your only strategy. Part 1. The math. If you want $40,000 a year in dividends, the amount you need depends entirely on your portfolio's yield. Let's say Apple stock currently pays 92 cents a year per share. At around $150 per share, that's a 0.61% yield. That means if you invest $100 into Apple, you earn about 61 cents a year in dividends. To get to $40,000 a year from Apple alone, you'd need about $6.55 million invested. But here's the good news. Most dividend-paying companies yield more than that. Look at the dividend aristocrats. Companies in the S&P 500 that have paid and raised dividends for at least 25 straight years. Yields here typically range from 1% to 4%. Take Chevron, for example, which yields around 4%. You'd need just $1 million invested to hit $40,000 in annual dividends. That's why yield is the game changer. Here's the quick table. 2% yield, need $2 million invested. 3% yield, need $1.33 million invested. 4% yield, need $1 million invested. 5% yield, need $800,000 invested. Part 2. The harsh truth. High yield sounds great, but be careful. Companies with very high yields often aren't reinvesting enough in growth. A T&T, for instance, offers over 5% yield, but has basically traded sideways for 20-plus years. If a company is paying everything out, it may not be growing, and that's a red flag. Also, let's look at reality. The average net worth for Americans in their mid-40s to 50s is about $833,000. Even at a 4% yield, that's just $33,000 a year in dividends, short of our $40,000 goal. And much of that net worth is tied up in non-liquid assets like your home. Part 3. A better strategy. If you're younger, under 35, the better path might be growth investing first, dividends later. Here's why. 1. You can take more risk. $1,000 earning 5% dividends gets you $50 per year. Not exciting. 2. You can focus on capital gains. Growth stocks can multiply your capital, giving you a bigger base to later shift into dividends. 3. You harness compound interest. Build up your portfolio now, so later you can convert it into income-producing assets. Think of it as a two-phase plan. Phase 1. Build your portfolio aggressively with growth investments. Phase 2. Shift gradually to dividend stocks, real estate, and other income-generating assets as you near financial independence. Part 4. Taxes and the formula. At $40,000 a year in qualified dividends, you could pay 0% federal tax under current U.S. rules if you stay under certain income limits. Over that, you'll pay 15% to 20%. And if you want to avoid taxes altogether in retirement, you could use a Roth IRA, where qualified withdrawals are tax-free. The formula to remember: needed annual income divided by dividend yield percent equals required portfolio size. Example: want $75,000 a year at 5% yield? You'll need $1.5 million invested. Bottom line, dividends can be a powerful part of your financial independence plan, but they're not the whole plan. Start with growth, build your base, then convert to reliable income. This has been your shot of biz, finance, and motivation.